Today I'll be presenting on Eris Life Sciences. The presentation is more of a thought process reflection from my own side, where I want to understand like how valuable are brands in India and what it takes to build brands and the whole life cycle management of brands. Just as a disclaimer, this is for educational purposes. I'm not a registered analyst, I'll disclose individual positions in the companies. I own Eris Life Sciences, and this doesn't, you can read the disclaimer here. So Eris Life Sciences is kind of a recent IPO. It IPO'd in 2017. So during 2017, it looked like a very, very pretty story. So the sales growth in the last 5 years was around 22%. Similarly, there was a massive expansion in margins. So operating margins kind of expanded from 20% to 35%. So did PAT margins from 15% to 30%. So everything looked very good, as is often the case in IPOs. But once the IPO came through, the story has been slightly different. So in the last 5 years since the IPO, sales growth has dropped to 12%. This is still higher than the Indian pharmaceutical market growth. However, it has gone down significantly from the earlier 22% growth in the previous 5 years. And even the margins that at the time of the IPO, the margins were kind of at the peak. And since then, margins have been maintained. So the operating margins have been maintained in 30% kind of a range. However, it hasn't expanded per se. So what story was sold in 2017? Eris Life Sciences was positioned as a domestic-only company selling chronic medicines in India with very FMCG kind of characteristics and a high growth potential, as they are mostly focused on chronic therapy. So diabetes and cardiovascular accounted for 65% of their top line, and then CNS accounted for another significant chunk. So if we just include chronic plus subchronic, this was around 90%, with acute only being 10%. Whereas for the IPM or the Indian market, the acute was close to half or a bit more than half the market. Also, because Eris is kind of a new company, it was founded in 2007, so it's barely 15 years now. In those 15 years, they have managed to build a few brands very well. So it was positioned as a domestic-only FMCG kind of characteristics, and it came with the IPO at around 40 times earnings. It's run by a medical representative and the management seems to be very growth and margin focused. And a good thing about Eris was this was profitable from the first month itself. And they have very, very sticky brands. During that time, they were building a facility, or they had a facility in Guwahati, and they were translating into an in-house manufacturing unit because that led to margin improvement for them. That could potentially improve margin. So now what I'm trying to evaluate is how the story panned out in the last 5 years, because the IPO came out in 2017. I look at the 3 individual therapies, the main chronic therapies. So first is the diabetes therapies. Here's the market share number since the IPO. Is there a noise somewhere? Let me just see. Yeah, this is okay. So in the diabetes therapy, Eris has consistently gained market share. This is data taken from Tijori directly. During the time of the IPO, their market share was 2.5%, which has improved to 3.5%. If you look at the top molecules, these are IMS, IQVIA, and so I've taken data from multiple sources, also the top molecules and how much sales happened in the secondary market. So this is secondary market sales and not primary market sales. So this is sales that actually happened from the retailers rather than the company selling to wholesalers. And we can see that growth in diabetes has been quite good in the past 5 years. It's been 17-18% compounded. And they have the biggest brand is Glimisave, which was launched in 2007. This has done reasonably well. It's kind of a mature brand now.
I think there is a background noise.
It should be okay now. So Glimisave is kind of their mature brand, which is showing maturity characteristics. It's a big brand. It's more than 250 crores, and the growth has kind of come down, but the brand has still done quite well. It's a very stable cash cow brand, and all the brands that that came out before the IPO. Most of them have done very well in the diabetes therapy. Since the IPO, they have had two launches. One is Zomelis, one is Gluxit. Zomelis was launched in 2020. And this has also scaled up very well. It has become a 70 crores brand in less than 2 years. And so has Gluxit also scaled very well. It's also become a 40 crores brand now. So in terms of diabetes therapy, execution has been top notch and at a much higher premium to what the market has grown at. If you look at the second big therapy for them, which is cardiovascular, here the execution has been reasonable. There has not been a big market share shift. So the market share has been around 1.92% in the last 5 years. Again, data taken from Tijori. And then if you look at their top molecules, the sum of the top 5 molecules has grown kind of 8%. And this is also what the cardiovascular market has grown at. So the diabetes market has grown much faster in India compared to cardiovascular. And Eris has kind of grown in line with the market. And most of their brands are kind of mature brands now. So one of them is more than 100 crores, Eritel brand, which has grown at close to the molecule growth rate. So they have executed very well in Crevas and Ellen Block. Ellen Block is especially special because there were lots of competitors which came up in this molecule, and Eris has done reasonably well. Crevas has also done well in the recent past. So here, execution has been average or slightly better than industry. And if you look at the third big segment, which is the vitamin, here they have also gained slight market share from 1.7, 1.8% to 2.2%. And here, if you look at their top brands, so the top brand, which was launched in 2007, is Remilin, and it has kind of been a 50 crores brand since the last 5 years. So not much growth. So has the case been with Teo, which has also been kind of a 50, 60 crore brand. So Eris did a big acquisition of Strides in 2017, where they bought out a number of brands coming out of Strides portfolio, and Renev was their flagship brand. And Eris has done very well since the acquisition of Strides, where the sales of Renev has grown from 80 crores to about 120 crores or 130 crores recently. So here the performance has been, the large growth has been due to Strides acquisition, so the Renev franchise, and then Eris has managed to grow this franchise quite well. So from these three last examples, what we can see is management has been able to build brands. So like Glimisave, which was launched when the company was launched, it has done very well. It's I think now in the top 100 products in India. Tendia, Ciblex, Adrock, all these are organic brands. So they have capability to develop brands. Zomelis was in, so Zomelis, the patent expired in 2019 and they bought the patent rights for, I guess, 90 crores or something. And that has paid off very well for them because they had a first mover advantage and they took it very well. And Gluxit is also a recent launch. So in terms of launching new molecules, they have been quite successful in organic in organic market building, as well as they have also shown good capabilities in acquisition. So the Renev franchise acquired from Strides, they have scaled it up quite well. And if you look at the other segments, this has been kind of the sore spot. So CNS, which is the central nervous system, this growth here looks very high. This is again because of Strides acquisition. So most of the CNS portfolio came from Strides. Before the Strides acquisition, it was a small portfolio for them, 16 crores. And then the Strides acquisition catapulted them to 100 crore kind of annual sales. But since then, the execution has been subpar. It hasn't grown in line with the market. Same has been the case with gastro and gynecology, where the growth has not been that high. Gastro, there has not been a lot of acquisitions in gastro. It's mostly organic, new product launches, and a few tuck-in acquisitions, but clearly it hasn't grown so well. So very good execution in diabetes, good execution in cardiovascular, reasonable execution in vitamin, and then the other segments, which are more acute focus like gastro and gyno, execution has been lacking. And this is a theme which comes out very clearly with Eris. That is, they are very good at executing in chronic division, but in acute, acute is not their forte. And only in 2020, they launched the OTC or trade generics division. And in the last 2 years, this has scaled beautifully, like 6 crores to 75 crores. This year, I think they did 100 crore plus. So the OTC or the trade generics, they have managed to grow quite well. So CNS growth came from the Strides acquisition. Execution has been disappointing in the acute therapies of gastro and gyna. and the recent foray into generics has brought in significant revenues. It's still not profitable for them, but it has brought quite a bit of revenue so far. If you just look at the last 5-year financials, revenues has grown at 20%, and all the profit metrics has kind of grown at 10 to 12%. So there has not been, so the IPO came at the time of peak margins, and since then margin improvement has not been very high. So in terms of cash flow, PAT, EBITDA, gross profits, everything, it's about 10 to 12%. However, this is not that bad. Actually, they are in the top decile of growth in terms of revenues. So in terms of top 20 companies, Abbott Eris's growth has been in line with growth in Dr. Reddy's and Abbott. So a lot of Dr. Reddy's growth has also come out of acquisitions. And then when we compare Eris against their mid-cap peers or other larger cap peers, the execution has not been that bad. So they have grown in line with the market leaders. They are still in the top decile in terms of growth. And they have been actually much, much better than companies like Lupin, which are also very strong in chronic. They've also been ahead of Ajanta Pharma, Zydus Cadila, Sanofi, Alembic. So in line with MNCs like Abbott, in line with Dr. Reddy, but again, Dr. Reddy's growth has also come out of acquisitions. So to bring all this growth, in the last 4-5 years, they have generated around 1,300 crores of cash flows. Out of this, 285 crores has gone into organic capex. So this is in building their factories and also acquiring the Somelis brand, so in licensing of that brand. And then 615 crores is the acquisition. It's mostly two big acquisitions for them. One was their Strides portfolio, and then there was another one which happened just before Strides in 2017. So overall, they generated 1,300 crores of cash, spent about 900 crores in capex, both organic and acquisition, to generate about 2 to 4% higher growth than IPM. So my question over here is, was all this inorganic expansion of 600 plus crores in the FY 17 to 21 range worth it? Is it worth putting this much money for generating 3 to 4% higher growth than IPM? And this is a question that I'm kind of that I'm myself grappling with, and I would love to get others' feedback on this. So among the stocks I discussed, I'm invested in Ajanta Pharma, Eris Life Sciences, and Alembic Pharma, and I've bought shares in all three in the last 1 month. My detailed portfolio is available, and I'm not a registered analyst. And with that, I'll be happy to take questions and also try to answer the question as to was the 700 crores acquisition worth it?
I have a couple of questions just to understand the business a little bit more, right? So when we are talking about brand, is this brand catered towards the healthcare professionals or the end consumers? That's one question, right? Because I'll give you an example. In US, pharma companies can directly market their products to end consumers. That means via TV advertisements, brochure distribution to end consumers with a disclaimer. Yeah, but
so,
that's not the.
I can answer your question already. So most of Eris's portfolio is super specialty in nature. So it's marketed to super specialty doctors, mostly cardiologists and diabetologists, and most of the most of the business that they get is out of prescription. But once you get into a prescription of a diabetes patient, then you're always there because it's kind of a chronic disease, and you always have to take the pills. And they have very minuscule OTC presence. So most of their brands is written in the form of prescription. So it's not direct marketing.
Yeah, that means right. Positioning as an FMCG itself is a questionable view, right? Because the characteristics of FMCG is you get distribution through intermediary, either retailers, distributors, and whatnot, but you actually communicate directly to end consumers, right? I understand back when they were trying to raise IPO for, they were window dressing and making sure it is a local FMCG kind of a thing just to get premium valuations. But but the minute you don't market to end consumers, it's a B2B business
So
altogether.
the FMCG positioning was also, I would not look at it as a company trying to communicate them as themselves as an FMCG brand, but the business characteristic is FMCG in nature. So what I mean is the return on assets, the kind of
Okay, the
margins,
financial,
the
okay,
financial
okay.
parameters, not the. So at the end, if you are into branded generics, you will your prescription will be written by the
Yeah, for
doctor.
sure.
So that is the community
Okay, got
who
it.
will be marketing you.
I think I misunderstood then, right? Uh, no, which makes sense, which completely makes sense. But in this case, it's all, you still have to put in the grind of having, medical representatives going and chasing doctors, and the same supply chain, all the distribution networks they will have to build like any traditional pharmaceutical company, right? So, and also if they, coming to your point of acquisition, if it is worth it, there are only two types of acquisitions that needs to happen within FMCG. One, either brands, or two, capabilities or R&Ds, patents and whatnot, right? If you look at it from this angle, right, in this pharmaceutical space, either they need to acquire brands which are already in front of these super specialty doctors. So that's why they're acquiring, because getting to these doctors is almost penetrating that market may be impossible. Maybe that's the reason they, bought themselves the customer base, or let's say revenue, basically. And second bit is if they can use this distribution power to also push their high profitable other product lines that might be worth it, right? Worth at a much higher margins. But the thing is here, this means it's super clear for me that they're struggling to expand their distribution. That's why they're acquiring.
Yeah. Also, so this is Eris was started as a marketing organization. So most of the products that they launch is not because of their capabilities in research,
Yeah.
but because they have the doctor connect and their MRs can be, let's say, more can sell more products compared to their peers. But then this is like most businesses kind of operate here. And I think most of the acquisition has been capability acquisition rather than just brand. So they haven't had a lot of acquisitions in diabetology or cardiology. Most of the acquisition is to try to give them an exposure to another therapy. So for example, the Strides acquisition gave them an exposure to the central nervous system, which is also a very important chronic therapy. Recently, they have acquired another company in India called Oaknet that gives them access to dermatology market. So most of their bigger, so they have been smaller tuck-in acquisitions, so like 10 to 20 crores kind of acquisition for a fun given brand, so one molecule which they might not have in their portfolio, and they just buy it and then try to build it up. So that is one. But most of the bigger acquisitions, so like 500 crore kind of acquisition, has been to give them access to another space where they are not present. So Strides gave them access to CNS, and the Oaknet acquisition has given them opportunity to participate in derma where they are not present.
Yeah, that's not clear, right? But Harsh, can we look at one acquisition that they did at least 3, 4, 5 years ago,
Yeah,
and how it has grown?
yeah.
If you're
So
telling, yeah,
so Strides acquisition is kind of that perfect opportunity to look at things. So this was done in 2017, so 5 years, long
yeah.
time. Uh, Mostly contributed to CNS division, which was very small for them. And with the Strides acquisition, this kind of became like 100 crore kind of business. And since then, it has been kind of stagnant. What has been very good for them is So one is the CNS growth, which kind of got catapulted from 20 crores to let's say 100 crores. And then the second one is in their vitamin division. They have this flagship Renerve molecule range, which was kind of small when they acquired Strides, which was like 70, 80 crores. And this has scaled up reasonably well. And I think this is the highest market share in its molecule range. So this is the acquisition which happened 5 years ago. And so one is in terms of how you can grow sales. So use the same marketing engine to sell more molecules. And the second is if you can bring in higher value addition. So can you improve your margins? So when they acquired Strides, they have been able to. So they first of all they took out a lot of molecules which were very small in nature, like 2 to 5 crores molecules. They took a lot of them out of the system. So that kind of reduced the sales of the Strides portfolio. However, they identified a few key brands for Strides, which Renerve was one brand, and then there were a couple more brands in CNS, which they have managed to scale reasonably well, not that well. In terms of margin execution, the gross margins when they acquired Strides was somewhere in the late 60s. This is scaled up to about 80 to 82% right now, which is kind of the company level operation. But also they paid a significant price. I think they paid about 500 crores for Strides. It should be somewhere. Let me see. No, let me just share the Excel because that has all the data in it.
No, that's fine, Harsh. What I'm thinking is, if their key skill set is marketing and sales execution, right? Acquisition of products makes sense, but the thing is the growth was stagnant, right? Because most of the sales sales, if it is sales driven, sales guys need products to go, sell, right? So they have the products now after acquiring, but still on an overall company level growth, it is much lower than the acquired products, right? That should tell something to us, right? That means their base brands are not does not have that much traction. So this again brings us to the acquisition bit. That means they have to grow. They need to acquire brands or molecules that their sales team can go execute. That means they need to constantly acquire. And if that becomes their strategy, they will always certainly overpay for every single acquisition. That means they will have more, uh, goodwill on their books. Can we look at the goodwill piece?
It's quite sick. And so this is most of the acquisitions. So so far they have not been, they have not paid top dollars for most of the acquisitions. So if you look at it, they have paid somewhere between 1 to 2.5 times sales for most of the acquisitions. The biggest one has been Strides. They paid about 2.5 times sales, but then they should be looked at higher because they pruned a lot of the tail portfolio. So the 200 crore sales was actually lower because they pruned maybe let's say 40 crores out of it. But apart from that, they have not paid top dollars. So mostly, if you look at all the acquisitions that they did and the sales that they brought, I think the number comes around 1.5 to 2 times what they did. So this is kind of similar to what ITC did in building the FMCG brand, although again, the nature of the business is very different, and then the customer stickiness in some ways is just different in the two. But I feel like they have not paid top dollar. So they have never had an acquisition for which they paid 5 times sales or 4 times sales. They'll be more measured. And I think one of their strategy is to have these acquisitions once in a while, like one of the big acquisition, and they take debt and then they pay it off, and then they kind of let the acquisition, they try to increase the efficiencies, the gross margins, the EBITDA margin. They try to streamline their workforce. But for me, like the bigger question is, how should we judge such a company? So it's very clear that if they didn't do any acquisition, their growth rate would have been in line with industry. They couldn't have had that. So the industry in this time period grew at 8 to 9%, and they grew at 12 to 13%. So a 3% extra delta came out of these acquisitions. So my question is, was it
So,
worth it? Like how do we judge that?
so Harsh, this is Simrat this side. So one thing which I have observed recently, like management saying when they do capex, so they say that they want the payback period to be 3 to 4 years for any capex that they do, right? So if we just look at this table, and I saw that they acquired Strides, I think for 500 crores in FY18, and their incremental sales probably haven't been that much since then. I think it's been closer to 500 crores only. So, like, if you look at in the totality of the Strides business, probably they haven't got the whole money back in 4 years that the Strides portfolio they acquired. So, if you go by this barometer, it seems like that they are like not getting the money back in the good amount of time period. And by this barometer, it looks like that either they are overpaying, or either uh, the inherent business strength is not there to be like just judged as a good quality business. How would you
So
yeah.
let's look at Strides, because that's like the easiest acquisition to analyze at this point of time. So CNS was a small division for them. After Strides acquisition has contributed 80 crores of annual sales. And I haven't put the FY22 numbers because the annual report is not yet out, but it would be somewhere around 100 crores this year as well. So in the last 5 years since they have done this rights acquisition, let's
Mm,
say the incremental contribution, let's imagine it to be 80 crores per year. So
mm,
over 5 years, that would be around 400 crores. And then the second molecule, which we shouldn't miss, is Renev, because
mm,
this is something which came out of Strides' books as well. And this is a 100 crore plus molecule. So it's like quite significant. And
mm,
in this time period, I think this has generated 500 crores of sales. So this was not present before Strides. So in the 5 years post Strides, they have got 500 crores coming out of Renev. And uh, in the CNS division, they have another, let's say, 400 crores coming out of. So that would mean 500 plus 400, so 900 crores. And
mm,
if we can imagine that, so company has been saying that Strides product portfolio is margin is exactly in line with the corporate level profitability, which is around 35% EBITDA. So 900 crores into 35, how much does it come? Let's just look at it quickly. So this has generated around 350 crores of cash for them. They paid 500 crores cash.
right.
So it hasn't completely paid out. In general, whatever the management says, we should also try to look at it from an industry perspective. In general, if you acquire pharma brands in India, most of the companies which bid for these brands, they have a payback period of 5 to 8 years is the
Okay.
industry standard. So if you go beyond 8 years, you are really overpaying. If you get it in 5 years, you're generally considered quite good, because uh, if you have your payback in 5 years, then that brand, if it becomes like 100, 150 crore brand, you can assume a 10 to 15 year residual profit. So you will make your IRRs.
Mm,
The IRR is always back ended. So I would imagine that this acquisition was kind of from an IRR sense, yeah, 500 crore outflow in the last 5 years. This has generated 300, 350 crores. So I think the payback period will be 7 to 8 years. So the IRRs will probably be around 12 to 15%. So lower than what they promised. But then we should also look at other acquisitions. So for example, there's Zomelis acquisition. They paid 90 crores for it, 96 crores. And this is already now generating 70 to 80 crores of sales each year. And this is also higher gross margin because this comes in the diabetes therapy. So I would say Strides acquisition was done kind of in line with the industry standards of 5 to 8, let's say 7 to 8 year payback. Uh,
mm.
is this the right way to look at this, by the way, in terms of payback period?
I think yeah, operating cash flows are should be the right way. EBITDA or operating cash flows.
Um, yeah.
And the second question which I had was like, how do you look at see, let's say Eris versus other players? I was a while back reading about JB Chemicals, and they have also, I think, acquiring brands and increasing MR productivity. So how do you see other players? And if you have to, let's say, rank top 4 or 5 players in domestic pharma, uh, who are branded generics players, so how do you compare them with the other players?
Uh, yeah, I'll just pull out some data for you. In the
Mm,
meanwhile, I think Vijay, did you have a comment?
Yeah, and it's actually a question, right? First, I mean, I like to go back to the fundamentals, right? If a company is acquiring to grow, is it right to look at the P&L? I think we should start off with the balance sheet.
So you mean like just in terms of how much intangible assets the
Uh,
company?
Not intangible. What I mean is we should look at their cash flows and see how they're funding their acquisitions.
Achha, okay. So here they fund it mostly out of their first Eris, they mostly fund it out of their operating cash flows. And even the operating cash flow to EBITDA is quite high for them. It's around 80-85%.
But do we have a breakdown of it? I think we can expand it, right? Let's
Yeah,
check.
yeah. You mean what do you want to look at? What do you want
See,
to find?
there should be a line item if they have acquired
Okay.
companies in balance sheet. They should have had saying acquisition of a company 200
Achha.
crores, whatever they have paid. There
So
is a line there.
I have put it in my Excel sheet. I pulled it out from the annual reports. So most of the acquisitions in each year is stuck in, except in FY 17 and 18, where they put 500 crores in 18, and in 17 they put about 80 crores in kinetics. And the organic capex is mostly the factories.
Yeah,
Uh, so
but don't you think the acquisition cost is low?
what do you mean? If you add it up, it comes to be around 615 crores. So the biggest acquisition was this 506
500
crores.
crores, right?
Yeah. Yeah, so this was the so actually they did big acquisitions in FY 17 and 18, and then they kind of they try to absorb it in their
Mhm.
business, these acquisitions, because Stripe's acquisition was a big one for them, because they were generating let's say 200-250 crores of cash flows each
Free
year,
cash
and
flow.
they kind of acquired 500. So they also had to leverage at that point. If you just look at their balance sheets in FY 17, 18, we can look at this. Like I think
Yeah,
they
yeah, debt.
drew 400 crore debt, but then they paid it off in 2 years. I think they kind of also canceled dividends at that point. They
Mhm.
just paid it off. And once they became debt free, then they again started doing buybacks and dividends.
But am I looking at it wrong in screener.in? Because this shows acquisition of companies almost 000,
Yeah, it's
right?
wrong. It's wrong. So this number should be here.
Yes,
Yeah,
yeah,
this
that's
number,
what.
and then even this number, like minus 77 plus 52 should be here. So
Yeah,
there are problems with screener numbers here.
yeah,
But I think if you want to look at this in a better way, intangible assets, like this would
yeah,
be a better proxy.
exactly. So no, but the thing is, this is actually promising, right? If it was my business, right? If I am acquiring, and I should first thing is pay less, as low a price as possible, and should be able to turn around and repay the total asset value in next 3 years. And that's clearly proven here, right? They've taken down the debt
Yeah.
to zero again. So the quality of acquisition is not the question now. Okay, it makes sense. It makes sense
So,
because
in terms of capital allocation, I always get the feeling that this management is a
doing
very
well.
banya kind of a management. They acquire something, then they're like, okay, 2 years, nothing. We just bake this in our numbers. We try to reduce the MR strength. We try to improve productivity, sell it more, improve the gross margins, pay down the
Mhm.
debt. Once it's down, let's look for the next thing. So the
Yeah,
next big acquisition only happened in FY 20, which you can
yeah.
see. Like this was the Somelis brand which they acquired, which was about 90 something crores, 96
And
crores.
that was funded through internal accruals,
Internal
I
accruals.
guess.
This time around, yeah, this time around they did not
It
need.
must be a small one then.
Yeah, it was 95 crores and they generate 250 crores.
Yeah,
Like
in
by that time they
operating
went
cash
up to,
flows.
yeah. So in terms of operating cash flows, they kind of went about 300 crores. And that's why they have now a cash. They also generated, now they have quite a bit of cash file. Like I think it's more than 500 crores
Yeah.
for them. So this business generates a lot of cash. So in these kinds of businesses, whenever I see business generating lots of cash and the existing business, if we take out the intangible, having very high return metrics, then the only thing, if I do a DCF, which makes a difference in terms of valuation is growth. So it makes sense that they would want to be more growth oriented, which they have also shown. Like if we just want to do a hyperbole, we can also say that they have grown 50% above the Indian pharma market, because Indian pharma has grown at 8% and they have grown at 12, 13%. So more than 50%. And it's in the top decile as well. Like they have grown faster than companies like Abbott and Sanofi's of the world. So they have done quite well. So my true thought process was like, how worth was it? Would an accountant look at it differently?
I'm not a big fan of accounting view of things. Maybe I'm just being naive, but the thing is, it's very simple, right? How much am I investing? When can I get the base investment back? And then what asset remains after I get my capital back? So the thing is, let's take the Stripes acquisition, right? They acquired it, they paid it off in 3 years. They have a product as an asset now, which their sales team can execute and start milking it over next 5 years time, right? So, okay, it makes sense that they want to build a decent product portfolio. That's why they're acquiring. But the catch is, as they grow higher, or let's say as they become a decent sized company, meaning 25, 30 crore market cap, or 2 times more revenue than current position, growth by acquisition becomes a pain, but again, that's not the case for all, right? Cisco has grown by acquisition pretty successfully, but their strategy was completely different. That's why the thing is, we need to see how they're approaching. We need to see the clarity. I don't have the clarity in how they're approaching a target, right? How do they identify a target acquisition? Then we can see the mechanics of funding it. That's fine, but how they're trying to.
I think I've been tracking this company for a few years now. A couple of mechanics is very, very clear to me. One is, big acquisitions happen when they want to go into another therapy, because they don't have a science team per se. They started an R&D division, but it's like nothing compared to the big guys. This is a marketing focused company. So for them, a lot of science, if they can acquire it, I think that's also fine. They're trying to do it organically now, but it will take years for them to build a good enough team. So when it comes to going into a new therapy, I think they are willing to pay a little bit more. So let's say 3 times or 2.5 times on trailing number sales. They're willing to pay that just because it gives them access to another, it improves their TAM. So it also brings in new doctor connect. It brings in new MRs who have expertise in newer divisions. So it increases their TAM per se. And when it comes to smaller tuck-in acquisitions, so these are like less than, let's say, 20, 30 crores, then it's mostly, let's say in cardiology, they have a bunch of brands, but they don't have exposure to a given molecule, and they don't see the logic of doing it in-house. So they are like, okay, we'll pay 10 crores to this guy. Let's acquire this brand and try to go this. So this tuck-in acquisition, they have done very, very well. Like they have grown. Because mostly they are not writing big paychecks, and in terms of newer therapies, the only time they did a big acquisition was Stripes, and it hasn't completely paid it. It hasn't completely paid it off. But I think that's also fine because they did not do it organically. Like, they couldn't have built a CNS division organically. And maybe when you go into a new therapy, it also requires a bit of time for you to understand how it works over there. And now they did an Oaknet acquisition, which was higher than Stripes. And that's because that gives them access to dermatology division. And they said, like, now that's it for us. We have all the therapies which we needed in our kitty. Now the focus would be on execution. And this is also evident in their track record. Like the Stripes acquisition was the big one. They kind of tucked it in. It hasn't completely paid it off by simple calculations. But yeah, that's, if you don't build it organically, you have to pay now.
Yeah, but just one question. It's quite curious. It's quite interesting and curious for me, right? This is branded generics, right?
Mhm.
If the product addressable product addressable market for this specific category of products is substantially larger, what is preventing other big, large generic pharma company to leverage and lean in and take away the market share from these guys? Because they don't have pricing power for sure, because it's branded generics. You have to play within the supply demand curve or the elasticity of demand curve.
So yeah, I understand your question. The only thing which matters is your relationship with doctors. So at the end of the day, if they write prescriptions and in their prescription they prescribe your drug, that patient is stuck forever, uh, especially in the chronic division, because patients generally do not switch between brands. So if I'm taking a diabetes medicine, I won't switch brands. So what? So before the IPO, how Eris used to compensate the doctors was in terms, it wasn't above board per se. There used to be 10% commissions to the doctors. After the IPO, this system has kind of changed a bit. Now they are much closer to industry standards, where they try to give them medicine instruments is how they would compensate. So there's another metric which people track, which is the number of prescriptions written by a given company per doctor. And Eris lies in the middle. The highest in India comes for Sun Pharma. I think an average doctor writes 84, mentions Sun Pharma 84 times in prescriptions, whereas I think Eris does it 50 times. But Eris is exactly in line with the industry. Sun has a much broader product basket. So a naive way of looking at this would also be so Eris is the youngest company in the top 25 Indian pharma market. They were only founded in 2007, and this was founded by an MR himself. So this guy used to sell medicines for other successful companies, and then he just decided one day that he would do it for himself. I think the basic, and even if you look at the total employee count, I think 3,500 there are 3,500 employees, and out of that, around 2,600 are MRs or their project leads. So about 70% of the whole company is just MRs. So it's a marketing setup completely.
Yeah, I think it's super clear now. I think we should not be focusing too much on their other operation. We need to only deep dive into their how the teams are structured, how they actually approach doctors, how they onboard them. That's the key research that we need to do. I mean, to understand more about this company, right? Financially, I mean, basically financially, it's relatively decent, right? Of course, I'm not a big fan of acquisition-driven growth, but they're playing to their strengths, right? Because they know that if I can acquire a product line and I can use my execution or sales and marketing execution to drive profitability and top line and bottom line growth, which is good. Uh, but apart from that, I think the whole company revolves around their key strength, which is the sales and marketing. But that's where tremendous amount of effort we need to put to investigate. And also, I'm a little bit. I was looking at their promoters holding, right? Since 2019, they have been divesting.
So
Is it for some
no, so
reason?
this is not from the guy who runs the ship. So this was founded by 3 or 4 people who came together, and the person who is divesting is not involved in day to day. So Himanshu Bhai is divesting, and Amit Bakshi is kind of running the show.
Yeah.
Himanshu is kind of he has been divesting. So actually, when he exits, it's a good time to look at the stock again.
Yeah, because it's a single person managed company, which gives far more flexibility. I mean, I trust the original entrepreneur being the key driving factor, because
yeah,
they are more ambitious, I would say.
And Amit is also kind of adding, he adds every now and then. I think when he has a
Yeah, yeah,
liquidity
yeah.
event, he kind of adds.
I mean, since 2019, this guy has added, right? But
Yeah.
yeah,
I think he sold after IPO a bit, Amit, and he again timed it well, his exit at that point of time. But since 2019, he's been adding. Also, the share price hasn't done much. Like there was a lot of
no,
euphoria, like when it came. I think they came out at a 40 times earnings or something. Like they came out at a good multiple, 35, 40 times, and now it's much, much more reasonable. And in this period, the earnings has grown. The sales has also grown decently higher than industry, and stock price is kind of low. So this is the classic typical company, like pumped up IPO coming out in October 2017. So
I
2017
mean,
bull market.
any funding, anytime any company wants to raise funding, they will window dress the company tremendously, right? Either for acquisitions or anything. That's why I don't trust acquisitions too much, because um, we had suffered, or at least during my career in Reckitt, I've done two acquisitions, or part of two acquisitions for integration bit, not the pure acquisition bit because I was too junior, but the integration bit was quite uh, my forte, right? So every time we see the valuation and the underlying operating models or operations never matched. So it was clear that the company that was about to sell window dressed quite significant amount of their operations to show higher profitability, to get you know to show
Evaluations.
better valuations.
Yeah. Yeah. Also coming back just to Simrat's question before I forget completely. So in terms of big pharma or top 25 companies, I think the ones which have been growing the best in the last 2 years. So this is from IMS data. Is the market leader Sun Pharma has been doing quite well. Mankind, an unlisted company, but has been doing spectacularly well. Torrent has been always very good in their domestic market. Ajanta has been doing spectacularly well in the recent past. Like some of the molecules in ophthalmology and pain therapies, you should look at it. It's very, very broad-based growth for Ajanta. AstraZeneca is also doing well, but this is not their listed company. This is the unlisted one. And Merck is again doing well, again, the unlisted company. JB Chemical, I've had very mixed views on it. So depending on what data source you use, so if I use the AIOCD data, which is this one, versus the AWACS data, you see a lot of difference in performance. So the secondary sales data for AIOCD doesn't show very high growth for GB chemicals. But if you look at the company numbers and then the other data set, it shows higher. So I just don't know what's happening there. Like, why is there such a big difference? Like, otherwise it doesn't look very high, but then the company reports higher growth. So I find it very hard to understand like which data I should trust. So that's why I do not know much about JB. Also, JB, a company should, which is so JB Chemicals is the kind of perfect company which I would not like to go at this point. It's bought by a private equity company. Uh, it was it has brought in a new CEO, so not the guy who kind of built the company, and they are acquiring at very high multiples. They are paying 4 to 6 times to acquire sales. Uh, you can call it whatever, but I generally feel that that's not a recipe for. So also the private equity, which kind of came in the company, doesn't have like a promoter mindset of 10 years or 15 years. So I just find it easier to play other games. For example, companies like Ajanta, where most of the growth is promoter driven, like more longer term orientation. Even in Eris, I'm more comfortable than JB. I just have a feeling that JB will go the Sequent Scientific route, the kind of money it's paying out for acquisitions.
Yeah, thank you, Harsh, for I think highlighting these points. I was not aware of a couple of points that you mentioned. And just one last thing. So I saw that Eris has 36% operating margins, right? Yeah, I think so. Only reason I could decipher that was that probably they are doing only domestic formulations. That's why they are having those margins, while other companies diversify into international markets.
So no, not really. The reason is they sell specialty products in domestic market. So if you're selling diabetes and cardiology drugs, mostly you make 80% kind of gross margins, which has always been the case for them. Uh, and this is a very high gross margin business. Whereas if you're selling OTC medicines, so things which you can buy out from, let's say, like I think Vijay was mentioning, where you build brands by advertising on television or things like that. Most of those have more FMCG kind of gross margins, which is somewhere around 60%. So if you look at Abbott's gross margin versus an Eris's gross margin, Abbott makes 55 to 60% gross margins, which is also similar for Sanofi, similar kind of product range. Whereas Eris's product is much more specialty in nature. So the companies in India which make very specialty molecules are Eris Life Sciences, Ajanta Pharma, Torrent, and Sun Pharma. So these four companies, even if you look at the gross margins, in India, most of them do 80% plus gross margin. So it's more to do with the product type, just rather than just the geography you're selling in.
I'll give you one example, right? Again, this is my experience. I was hired or I was given an offer in AstraZeneca. So before I could accept or reject the offer, I was trying to talk to the VP of finance. Their average margins on prescription medication is 130%.
130, what does that mean?
So they sell more, let's say 3, 4, 5 times more than their cost of goods sold. And then they start giving discounts.
I see. Yeah, like most of the prescription medicine business, it's very high gross margin.
Oh man, you should see, because they were targeting, they wanted to hire me to optimize their factory operations. Because what has happened is, because of the high margins that they have been seeing, their supply chain is not optimized enough. And the VP for finance thinks they can add additional 20 to 30% incremental gross margin just by fixing some low-hanging fruits within the supply chain. Like very simple product costing. Their product costing is too complex. If they simplify product costing itself, they can understand what is the real cost of a product, and then with that they can actually cut down on operating inefficiencies, or if we need to position it in one warehouse or another, such decisions could be easily made. So he was their focus for next 3 to 5 years is supply chain optimization, right? So margins in prescription medication is massive. The only problem there is the growth is slow. Growth meaning the pace in which they move is slow, because given the regulatory environment they operate in. That's the reason their whole ethos of an organization is slow. Even a single decision, they need to go through hundreds of approval chains. That's why you can see all these global pharma, right? Unless there is a pandemic or such situations, their growth will be flattish to positive, unless they get a blockbuster patent approved for specific categories of diseases or therapies and whatnot. So I mean, it's a right place to be in. If we can have even a slightly higher industry average revenue growth, that stocks can, that companies can fly, right? It's more about sustainable growth at the same pace without having any legal entanglement or quality issues and stuff like that. If they can do it for 2, 3, 4 years, my God, those companies can run.
Yeah, I agree. Like also, these are better profit pools in a way. It's very hard to take away the profit. So it's hard to break into branded generics because it's slow. You need time, and that's That's why the profit pool is intact, because nobody can just come in one day and like take away all the profits. It just doesn't work that way. So it's a better profit pool that way. Also, just coming back to Eris, like I was just looking at the number of companies in India which make 400 crores of PAT in pharma. There are not so many. So a 15-year-old company only selling into India, nowhere else, has managed to do that. Like I'll just show it to you guys.
No, they have decent cash flows. They have enough. I mean, this could be worth investing in, if not 10 or 15% allocation, at least 3 to 5% is warranted. Or if that is not comfortable, just allocate 7% on a total pharma, pick Ajanta or Eris, some of these reasonably valued pharmaceutical companies with stable growth.
So you see, like there are 15 companies listed which makes 750 crores profit, and I'm sure like Laurus's profit can go down quite quickly as well, because what they have built is not stable sales. Like so, uh, yeah, there are not so many companies, and a company which only came back 15 years ago without scientists managing to create 400 crores. I think they're already in the top 20 or 25. Yeah. So they actually, the next one in line is JB Chemicals. Good to know. Now, branded generics creating this profit pool, it's hard, but once you have it, it's also very stable profit pool.